Welcome traders. In this episode, I want to improve your trading by clarifying the difference between trading and investing. These are two very different money-making activities, and you would be forgiven if you thought they were the same thing. To make it worse, there really isn't a lot of content out there about this very important topic, and it can literally impact your performance results as a trader. How can you be expected to be good at something if you're being given conflicting instructions? You can't. Let me explain. Let's talk about investing first. Investing is a passive activity. So what do I mean by this? I mean that it's not a time-sensitive, high-pressure task, or at least it shouldn't be. I'm going to oversimplify it for the sake of this video. But investing is almost always when we have cash that we can afford to put into something that we hope will give us a greater rate of return than a high-interest bearing bank account. So traditionally, our options have always been real estate, property, or stocks. Then, depending on the amount we have, we would choose whichever one made the most sense to us. Usually we would put it in as quickly as possible because our thinking is that the sooner we get it invested, the sooner it can start growing for us, right? So, because we've decided to invest it as soon as possible, the exact price we get in at is usually not that important to us because we're thinking long term. Finally, as long as we don't need the money back anytime soon, we are often happy to just leave it in the investment as long as it's growing. We're not normally in a rush to get it back, and we may even leave it alone to keep growing entirely. So far, this means leaving it alone for as long as possible, which is why I say it's a passive activity. Side note, without realizing it, we have already constrained ourselves to certain asset classes. Asset classes are groups of investments that exhibit similar characteristics, such as stocks or properties, commodities, cryptos, and fiat currencies. We have now limited ourselves to investments that we want to go in only one direction, up. We're looking for value, and we want value to increase over time, so that means it has to go up. Some asset classes, including commodities and foreign exchange, can have seasonal swings, or they can range for long periods of time. They might even go down for longer than they go up. They're probably better for trading. So let's talk about trading. Trading is a month-to-month income-earning job. It is an activity that is meant to subsidize our main income or even replace it. This means that in order to get your paycheck or pay your bills, you must have banked enough profit. In order to have profits, you must have closed out enough positions. In a very real way, this means that our approach to making money cannot be based on longer-term ideas, as we don't have the luxury of time. This is why day trading is popular, and it requires a state of mind to be built up. Day traders can only focus on immediate opportunities in the markets, what may be available in the next few hours or the next few days. Unlike investing, traders must have a precise price level entry, and they must have an exit strategy if things go good or bad. Either way, they have to close out that position within a time limit or by a certain price. However, they can participate in a lot more markets because they can be both a buyer or a seller, all depending on which way the markets are moving that day. In fact, it's possible they may even be a seller one day and a buyer the next, all in the same market or even in the same day. So, to sum up, you will need to make a choice between which one you are every time you enter the markets. A trader cannot serve two masters. If you're serious about trading and you want to learn more, then get in touch with me on my ambassadors homepage at FXGlobe.